So where are we going and what does this all mean? I don't really know, but I'll tell you anyhow. Go to the next slide. You know, having done this for 35 years, people think I know what I'm talking about, so hopefully. This is a really interesting time, and one of the things that's happening right before our eyes, if you look at that graph on the right, now that's actually through 2022, I think. This is showing the relationship between cap rates and the cost of debt. Those have crossed over now, where for the first time in over 20 years, cap rates are lower than the cost of debt. This is a phenomenon that people are calling negative leverage. What does that mean? Well, in theory, if you finance the building with all debt and your cap rate was a 5 and it cost you 6%, you'd be bleeding cash, right? So if you start thinking about paring back that debt, there is still a world here where you're either neutral or maybe negative on cash flow. And funds and investors are trying to grapple with how to deal with this. And I'll talk a little bit more about that. But I do see a change, which is going to be a change for a while. I don't think we're moving so fast from this negative leverage environment. If interest rates go down, I think cap rates march with them, which will continue to keep the spread negative. And so what does this mean? What this means is we're going to go back to the way real estate used to be before financial engineering really took over. And we're going to look at buying properties that are great, owning properties and working these properties. We're going to probably go with less leverage. We're going to have a longer time horizons. We're going to moderate our return expectations, although I do believe they'll exceed what our underwriting might be for a lot of reasons, which we'll talk about. Today, you need to look at things with a little bit more jaundiced eye, I believe, and a little bit more patient capital. This is a real challenge, by the way, because most private equity funds and opportunity funds and all these guys who were 3-year money built their fundraising on the world that was. So that world that was is over. Yes, distressed debt it's going to have its day a little bit, but not as much as everyone thinks. But so now they're going to have to go back to their LPs at some point and say, you know what, we promised you a 17 or an 18 on an opportunistic basis. It's going to be a 14. What do you think? LPs are going to have to acquiesce because there's no other choice. So basically, this process of changing expectations with capital, it takes time. So we're going to be in this world for a while of uncertainty with capital and kind of with the interest rates and so, but at the same time, what's going to happen? There's going to be what I'm calling forced sellers that for whatever reason or not have to sell. Maybe they have debt that's maturing. Maybe they're a fund and they have an end of life issue where they need to start disposing of assets, and they would have liked to got a 25 IRR instead of getting in 16 IRR, and they're taking the money and going home. So we're going to start seeing properties come to the market at a time when you wouldn't think they should be coming, which is going to open up opportunities for those who have the right type of capital and can approach the game in a different way. You know, I've always felt, and maybe I'm wrong here, there's so much liquidity in the world today that those loans will get disposed of in an orderly manner. There'll be some pain, surely, for some guys. There'll be creative ways to absorb that pain. Maybe there's something called hope certificates or other ways to kind of stretch out the possibility of getting your money back at some points. But I don't think this is a disaster world ahead of us. And I think the regional banks, first of all, the Fed can't let the regional banks fall. So they're going to have to figure out a way to solve that. But secondly, already now Signature Bank's loans are out there shortly with Newmark. And you're going to see those sell, I don't know, 90 cents maybe. They're not going to sell to 50 cents. The world has just got too much cash. And by the way, underneath all this, real estate's a good investment still. Multifamily, it's industrial. We'll talk more about these, but their underpinnings are terrific. So this is not 2007, 8, and 9. And by the way, during that era, the amount of capital on the sidelines was infinitesimal compared to the amount we have today. So as I mentioned early on here, you can't underestimate the effect that technology and demographics are going to have on shaping real estate going forward. And that's going to be an important part of what I'm discussing today. I think the places that I like a lot are continue to be industrial, multifamily, and splinters of multifamily, built to rents and some other strategies around that. I love the active adult communities. Cold storage is continuing to be a very interesting area. Data centers are on fire, and they're going to continue to be on fire as we continue to produce enormous amounts of data. But here, this is the kind of the theme of all this today is the obvious as we go forward is going to be overpriced. You have to be thinking about where things are going. And one of the great masters of this is Blackstone. If you look at their site and you listen to John Gray speak and the others, they're always thinking about where things are going. They were one of the early pioneers in the recent era of making big bet on data centers in the last few years, among others, obviously logistics and others. So it's kind of consistent with my theme today, which is make bets on really interesting areas that are growing. So I consider the years ahead the golden years. Again, I've been doing this a long time, and we've had a nice run, but we're moving into an era now that is just uncharted territory by volumes. If you look at, interestingly, if you look at the lower right-hand corner, that little chart there that talks about the amount of data we're producing every day, that number is actually a little old. That was a few years ago. Today it's 3.5 quintillion bytes of data every day. A quintillion is one followed by 18 zeros. All right, so it's a big number. And the chart above it is showing the amount of data that's being created from 2010 through 2025. And they use a term called zettabytes, which are a zettabyte's a trillion gigabytes. 1 gigabyte is 350,000 emails. All right, these are numbers that we just don't understand. It's almost equivalent to thinking about space travel. You know what I mean? Like to go to the nearest star is X number of years or light years, right? So we're moving into another place where we're trying to comprehend things we've never comprehended before, and that's going to have a big impact. And it's going to carry through not only society, but particularly real estate. The other thing that's going to be happening here is, as you know, is that more and more people have smartphones. In 2008, 22% of the population had a smartphone. Today, it's over 85%, moving to 90%. So, and as the generations change, kids are growing up. I mean, cell phones are in their cribs when they're born. I mean, like they give them to the mother at the hospital and they hand it to the baby as they come out of the womb. So we're this generation, and it's emerging now. It only knows that world, right? Guys like me are catching up to that, but I still talk to my children about how to do things. And that change is going to occur, and it's only going to increase the ability to use the smartphone. So we're going to have this convergence of a massive amount of data being generated, and 5 to 10 years, probably closer to 5, we're going to have quantum computing coming in, which is 158 million times faster than the fastest computers today. Interestingly enough, I'm not sure if you guys caught this yesterday, Tesla stock zoomed up. And it wasn't because they're selling more automobiles. It's because they're working on a new supercomputer, or they have been for the last number of years, which the street thinks could generate $500 billion of value for Tesla. That's why it's a stock that's very interesting to own, by the way. But this is going into the idea of what does all that mean? Like Tesla, they're going to have more plants. They're going to need more data centers. Just that little slice of that discussion and the ramifications to real estate are what I think about every day. So let's go on to the next page. So these are, look, this topic of the themes in real estate could be a full course. I'm trying to do this in 10 minutes. So I'll hit on the high points, but we're going to continue to see obviously a migration from brick and mortar to online, and the speed in which the internet is going to enable you to access. So virtual reality is going to become more prevalent, because you'll have the ability to really look at things online in a robust way. And also, as I said before, demographic shifts. Most of the younger people today are buying stuff online, where our generation still used to like to go to the grocery store and look at the bananas. That doesn't matter, and as far as clothing or anything like that. So we're going to continue to see that. But at the same time, ironically, a lot of these online companies are going physical. So Warby Parker decided, hey, it's nice that I can send them 5 pair and they can send me back 1 or 2 or 3 pairs. It's expensive to do that. It's cheaper for me to get a retail space, have them come in, look at the glasses, try them on. I get a higher hit rate, right? And then I'll send it to the guys. So you're going to see more and more of that, because people still want to have the experience of going in and seeing. It just may be the delivery of the inventory may be less, but the experience is still going to be there. It's the same thing with movie theaters. It's the same thing with how we socialize. I mean, a quick story. Years ago, I went into a hotel in New York called the Ace Hotel, which was a pioneering hotel at that time. And in the lobby were rows of tables. And I walked in there and I noticed the place was packed, but everyone was on their phones. They weren't interacting with each other. They were looking on their phones. They could have been in their room. They could have been elsewhere. There is this world where we still want to be people, even if we're communicating in a different way. And I don't see that changing. I'm not saying go out and buy AMC stock, but I do believe that the theater business is probably one that's overly. I think its demise is overly stated. So the next area that I think is really interesting is going to be universities. Universities are going to benefit significantly from AI, robotics, software, hardware, life sciences are all going to boom, and they're going to start largely at universities. And so the IP, the intellectual property, is going to be generated. And what's going to happen is there's going to be an ecosystem that develops around these places, particularly universities that have very strong healthcare systems. And so we're going to see people staying around longer. They may live there. You're going to see seniors. We're seeing this as a theme right now that want to be near universities. They want to go to the football games. They'll take classes. They want to walk around the campus and feel young again. The effects of universities on their communities. The thing you got to be careful about is some of the secondary schools and secondary locations, I think, become obsolete. And the rising cost of tuition, et cetera, is going to probably eliminate a lot of schools in the future. And so I'd be careful about, for example, student housing in those markets. We will, obviously, COVID really emphasized the movement to what I'm calling lifestyle cities, Bozeman, Orlando, Boise. I think that that's going to slow a little bit, and it has, but long term, we're going to continue to see people moving to these markets. And you're going to see companies follow behind it. Software companies will open in maybe a branch of Microsoft opening in Boise. And by the way, they'll make them come to the office largely. We'll talk about that in a second. And so I think this trend is one that's kind of one of those irreversible trends. And I think also we're going to see more of these, more of these remote towns are going to be become more reachable. Driverless trucks will go overnight to deliver goods to them, drones, other, obviously communication through the internet. And so you might see markets like North Carolina, South Carolina start growing. Surely the center of the country is going to be a place that continues to grow. Besides the smile, you can't minimize the effects that millennials and seniors are going to have on the world, in real estate particularly. Social media, for example, is going to continue to become more and more important in our world as younger generation utilizes that. This shapes opinions. It affects things like apartments.com, where people say, I went out and walked my dog and there wasn't a big enough dog walking place. This place sucks, right? And it gets spread in 2 seconds. The other thing that's interesting, and this is just an aside, with social media, is you can coalesce a opposition group in 5 minutes. We ran into this recently at a project we were trying to get approved in Connecticut. And they put up a website. In a matter of days, they had 900 people. And when we went to our first meeting, they had to move it to another venue because there wasn't enough room. So that's going to have an effect on the ability to develop in the future, right? So we're going to have, this will come into play, and we'll talk a little bit about it. While there's some markets that are overbuilt right now, long term, you're going to see a shift, and we're going to be short product because of largely opposition to development. I think we're going to see continued repurposing of real estate. Malls obviously are prime candidate. We way over malled even before COVID. We had too many malls. It's just because life companies and other guys just gave the developers money, and developers are pigs. They'll take the money and build anything. So I'm excluded from that. But and that's what they did. But for 20 years we've been over malled.
Office?
We'll get to I'm going to talk about office in a second. I know you're anxious to hear that, Marty. So office is one of those, but let me jump into that. But so we're going to see more and more, and I think one of the themes that we're going to think about here is authenticity. More and more, as we become a little bit more impersonalized, as we look into our phones, yet at the end of the day, I think people still want to feel things. They want to taste things differently. I think genuine is going to be important. I tell a story of a warehouse building that was being converted to residential in Williamsburg, and the developer, a friend of mine, was walking me through it. And I looked at the floors. It was like the pitted wood floors, and I looked at the ceilings. It was the concrete ceilings with some light bulbs hanging down. And I said, okay, so this is really nice. When are you going to finish this place? Oh no, it's finished. and I'm getting a premium versus, you know, places with drop ceilings and nice clean walls, because people wanted something that's they could taste, they can touch. And it's, you know, it's just ironically, I was thinking about this with jeans. I mean, like, the more rips you have in jeans, the more expensive they are, right? Because it looks authentic. I think we're going to the place where, you know, there'll be just one string and it'll be $1,000. You know what I mean? But so I'm making fun of this, but I think that repurposing of interesting real estate that was built a while ago could be something that, particularly around resi, I think is going to be an interesting area. And then the last thing, again, there's a lot of themes, but one of them is the broadening definition of real estate. Lifestyle, Lifetime Fitness, for example, which you guys may know about, is a really fantastic brand. It's a fitness brand, but they're also now in residential, and they have like a WeWork operation, all stacked in a vertical environment. So the whole building is, let's say, this company. You couldn't finance that years ago. How do you finance health clubs? How do you finance? So car washes today, everyone's running around loving car washes. I mean, they're nice, but I'm not going to pay a 6 cap for a car wash, which is where they're trading now. But car wash is not really a real estate play, but yet you'll get real estate money to fund it. And you didn't have that if you go back historically. So I think we're going to continue to see a broadening of the definition of real estate and the capital. There's so much capital out there that they're going to be looking for alpha. They're going to run